I want you to look at the chart on your screen right now. Do not look at the price. Look at the line. Look at that massive vertical line stabbing up from the candle. That is not just a wick. That is a crime scene. Price of silver flashed to 83.71. It didn't drift. It teleported. 1 minute we were at 79. The next minute we were at 83. And then, even faster, the rug was pulled. The price collapsed from 83.71 down to 74.47. A $9 swing in a single session. If you're new, you're probably frozen. You see the drop and assume the rally blew up. You think the bubble popped. But if you've lived through 1980 or 2011, you see the body language. This was a stop hunt. A calculated algorithmic ambush meant to wipe out the leveraged chasers who piled in on the gap. The order book was thin. Liquidity had vanished during Ghost Week. The banks watched the book and saw an empty middle. They allowed the price to spike to 83 to lure in retail FOMO. When the trap filled, they slammed it shut. In this part, we will dissect the anatomy of that $9 swing. We will map the stop-loss cascade step by step. We will show why the paper price did a heart attack while the physical market barely blinked. Who bought at 83? Not the smart money. The buys at 83 were chasers, margin traders, people using 10-to-1 leverage. They put stops near support, 75, 74. The banks know those clusters. So what did they do? They sold a massive block of futures at the high. That pushed price down to 79, then 78, then into the stop zone. Snap. Thousands of retail stops triggered. A cascade began. Forced liquidations created a waterfall. The price dove to 74.47 because positions were blown out by margin mechanics, not because fundamentals changed. And who was waiting at 74? The very firms that sold at 83. They sold the spike, triggered the stops, watched the cascade, and bought the wreckage back at a discount. Sell high, force the stop, buy low, rinse, repeat, brutal, effective. But there is a key distinction. This was a paper event. The paper market, futures, options, algos, whipped like a flag. The physical market behaved differently. Dealers did not slash coin prices by $9. They held spreads or even raised premiums. Why? Because they treat inventory like ballast, not a casino ticket. If spot snaps back to 83, a dealer who sold physical at 74 loses money. Dealers refuse to play that volatility game. So if you were waiting to buy physical at the flash low, you probably missed it. The 15-minute window was mostly illusory. Sites crashed. Inventory read out of stock. That proves the divergence. Paper volatility, physical resilience. Here's why this matters. A violent paper dump that doesn't drain physical supply means the underlying liquidity is tight. It means the waterfall only removed leveraged speculators. The real holders, industrial buyers, sovereign stacks, collectors, kept their metal. The banks cleaned out the gamblers and walked away with cheap paper positions, but they did not hoard physical metal. The physical floor stayed firm. Next, we will map the exact stop-loss geography on the order book and follow the money. We'll show the timing, which blocks were sold when the cascade hit the critical stop zones, and how the bids at 74 absorbed the flood. But remember this. Despite the wick, the day closed green relative to last Friday. From last week's close to now, silver is still up significantly. The breakout remains intact. The easy money phase is over, but the trend is not dead. In the next section, we decode the candle pattern, the shooting star, and why, despite its scary upper wick, it often signals a healthy flush rather than a terminal top. Let's slow the tape down. Not the chart, the mechanics. When price leapt from 79 to 83, it wasn't fresh news. An execution algorithm found a vacuum and sprinted into it. Ghost Week had hollowed the order book. The algos pushed. Here's the map. A single large sell block was executed at the spike. That order wasn't accidental. Think demolition charge at the peak. When it detonated, the tape ripped open and the cascade began. Retail piles in on a gap because FOMO drowns risk. They used leverage and placed stops just below where they bought. 75, 74. Brokers route those stops. Exchanges match them. An aggressive seller hitting the top sends price slicing through those lines like a blade. Two gears, liquidity and leverage. Liquidity was gone. Leverage was everywhere. Combine them and the market is a powder keg. The explosive element is margin. When margin thresholds breach, platforms automatically liquidate. Liquidation orders fuel further declines. It's mechanical, no emotion required. At 79, the market had bids. At 83, the bids thinned. The aggressive sell removed resting bids. At 78, the first wave of margin calls hit. At 76, more. At 75, the stop cluster detonated. In 60 seconds, thousands of retail positions were blown out. Spreads widened. Slippage spiked. Liquidations cascaded. Who placed the initiating block? We can't name the firm from public feeds, but the pattern is clear. Sell high, create cascade, buy the washout. Institutions with deep pockets and delivery capacity do this because the payoff is large. They can accept a paper loss to capture cheap contracts and later move into physical. Timing matters. These blocks appear in thin windows. Weekend gaps, holiday vacuums, off hours. The spike to 83 happened in such a window. That was positional, not random. Microhook. In a moment, we'll show why algos love stop clusters and how they can predict them. Breathe. This is not mystical. Banks and flow desks catalog retail stop concentrations. They see where margins sit. A single smart execution triggers a predictable chain reaction. Contrast hook. It looks chaotic to you. To them, it's choreography. Look at the tape prints. There were blocks printed at the high in sizes that dwarf retail flow. When those were matched, the resting bids were vaporized. The liquidity hole meant each subsequent sell pushed price further until the automated margin engine kicked more orders out. That cascading math is simple arithmetic. One forced sell makes room for two, then four, and the feed-forward loop accelerates. They place passive bids at support, 74, 75, waiting to pick through the rubble. Aggressive execution plus patient buying creates the round-trip profit. The initiating sellers choose times where resistance is weakest. Weekend gaps and holiday vacuums are windows of opportunity. That's why the spike happened when it did. So who bought at 74? Not panicked retail. Heavy accounts, industrial buyers, strategic allocators, and sometimes the same desks that pushed the spike were waiting at support. They absorbed the cleared tape. That's why price rebounded quickly to 78. Structural bids were real. Empathy anchor. Getting stopped out at 75 hertz. It is painful by design. The lesson is simple. If you weren't levered, you own more metal now. Retention hook. Next, we map how dealers and coin shops behaved during the cascade, why their reaction proved the crash was paper only. Look at that candle. The long upper shadow and tiny body. Traders call it a shooting star. To the novice, it reads like a hand slapping the price down. To the headline writers, it's a top. But context changes the verdict. A shooting star signals rejection. Buyers tried higher and sellers shoved back. Yet when that wick prints on low volume during a holiday vacuum, it often means one thing: liquidity test, not capitulation. Microhook. Later, we'll show why this wick actually increases the chance of pension cash entering next month. Break the candle into 3 moves: ramp, probe, rejection. The ramp is the fevered climb into thin bids. The probe is a quick test of supply at the high. The rejection is the shove down when an aggressive sell meets empty order books. The probe found sellers, not buyers. That matters. Compare today to Friday's close. Last week ended around 71.91. Despite the intraday drama, the daily body finished well above that. Strip away the wick, and the breakout remains valid. Emotion screams. The chart whispers the trend. Contrast hook. Gold is the calm sibling. Gold barely budged. It held at highs while silver spasmed. Gold anchors the system. As long as gold stands, silver's floor is guarded. Silver is the high beta sibling. It overshoots both ways. Volatility is the price of outsized returns. Expectation? Consolidation. The market will likely chop between 75 and 80. Algorithms will back off because realized volatility spiked. Momentum buyers pause. Option sellers grin. The grind is boring by design. It flushes noise and forces patience. Pacing, reset. Do not confuse intraday panic with a structural reversal. For traders, shrink size and respect the new regime. The easy money phase is over. Options suffer from time decay during chop. For holders, this was a cleansing. Weak hands were flushed. The position book is cleaner. That is constructive. Empathy anchor. Feeling queasy is normal. Reason follows emotion. Look to weekly and monthly structure for clarity, not the intraday wick. Retention hook. In a moment, we'll quantify why a green close above 75 matters far more than any flash wick. Quantify the mechanics. A long wick creates a resistance zone at the spike. Buyers who chased become bag holders. When price revisits that wick, many sell to break even, producing supply overhead. The path up must chew through that float. Opposing force. The stop hunt expelled overlevered players, reducing open interest and structural fragility. With leverage cleaned, future rallies face fewer margin trigger risks. The market paid a short cleaning fee to become sturdier. Gold-silver ratio. At the spike, the ratio compressed. At the dip, it stretched. Today's bounce shows silver still outperforming relative to gold. Institutions watch the ratio more than intraday noise. That relative strength matters for allocation decisions. Microhook. Next, we'll reveal the dealer reports that prove the dip was paper only, and why that flips the narrative for physical buyers. Practical takeaway: expect a multi-day digestion in a defined range. Defend 75. Avoid oversized option exposure. Treat physical as a stability anchor. The candle was a test, not a tombstone. The market tapped the brakes, found support, and is now digesting for the next leg. Also, watch the calendar. The month and year close are days away. A monthly close above 75 sends a seismic message to long-term allocators. Algorithms care about daily noise. Pension funds care about monthly math. That difference will shape January flows. The screen screamed chaos. The coin shop barely twitched. When spot plunged from 83 to 74, you expected street prices to follow. You expected dealers to slash premiums, to dump inventory. That did not happen. Dealers held firm. Some widened spreads. Some even raised premiums. Why? Dealers price for delivery risk, not intraday paper noise. Sell a coin at 74 and it snaps back to 83. The dealer eats shipping, spread, and arbitrage. They refuse that roulette. This divergence is the single most important clue. Paper can be flexed and synthed through leverage. Physical metal requires settlement, logistics, and capital. Dealers are custodians. They don't treat inventory like a casino ticket. Microhook, coming up. How minute-by-minute premiums confirmed the paper-only panic. At the flash low, online listings mostly read out of stock or showed steady to higher premiums. Brick-and-mortar shops reported demand, not dumps. Customers called to buy, not to sell. If real holders were capitulating, we'd see boxes on auction sites and vault inflows. Instead, we saw scarcity and measured buying. Industrial procurement matters. Solar, electronics, and medical buyers run hedging schedules. A sudden $9 drop often triggers automated buys to secure production. They don't scalp overnight. They take delivery. Those purchases absorb the cleared tape and push price back up. Empathy anchor. If your stop was hit at 75, it hurts. But emotion is not the market's engine. Logistics are. The market cleared the speculators. The physical bid stayed intact. Here's the counterintuitive part. Premiums can rise while spot falls. Dealers anticipate delivery pressure and price and risk. A rising premium amid a lower spot is a real warning that physical demand is firm. It flips the headline narrative. Technical constraints worsen the illusion. Retail platforms throttle during spikes. Carts fail. Fast institutional procurement wins the fill. The 15-minute window was real on tape, but mostly inaccessible in practice. Retention hook. This is where owning an ounce diverges from owning a future. So who captured the bargains? Not panicked retail. Strategic buyers with logistics and credit lines, and sometimes the desks that engineered the spike were waiting at 74. They bought paper or took delivery, depending on balance sheets. That's why the rebound to 78 was swift. Bids were structural. The practical takeaway is simple. A paper smash that doesn't produce physical sellers is a bullish divergence. The market expelled the weak hands and left the strong holders. That's a healthier foundation for the next leg. Minute by minute, premium behavior told the tale. When spot flashed down, some online sellers briefly paused orders. Others pushed premiums higher by a few dollars to reflect fulfillment risk. Phone lines lit up with verified institutional orders, accounts with logistics, credit, and scheduled delivery windows. Retail checkout queues timed out. The result? The physical distribution system favored organized buyers, not the social media chasers, who screamed buy the dip. Watch the delivery friction. Processing delays, fulfillment holds, and available to ship toggles are real signals. When those back-end flags flip to limited during a crash, it's not market manipulation. It's logistics intersecting with scarcity. That shows the gap between taped spot and the price to take delivery. Next, we'll interrogate vault flows and inventory reports, the hard numbers that prove whether metal left storage or piled in. If inventories fall while spot dips, the paper market is lying and the shortage is worsening. If inventory leaves vaults while spot crashes, that is proof the tape is lying. Vault flows are the hard evidence. Exchanges, mints, and custodians report physical movements, in or out. When spot collapses and inventories climb, that's capitulation. When spot collapses and inventories fall, that is a bullish divergence. Buyers with delivery capacity are converting paper into metal. During today's flash, dealers reported outflows. Phone lines lit up with purchase orders from procurement desks, not frantic liquidation calls. Industrial buyers don't gamble on intraday spikes. They lock supply for production. When they see a temporary gap, they execute contracts to take delivery. That moves metal out of vaults, even as the ticker looks broken. Microhook. In a moment, I'll show which inventory reports matter and how to read them. Volatility is a tax paid by the overlevered. Futures, options, margin accounts. Those instruments were the cost of a $9 swing. If you were levered, you paid that tax in forced liquidations. If you held physical, your ounce stayed an ounce. You gained price discovery without losing metal. The currency check matters. The dollar index was relatively flat during the flash. If silver collapsed everywhere, it would be macro. It didn't. This was a structural liquidity event inside silver's paper market. Why flushing leverage helps. Open interest drops, fragility declines, and the market becomes safer for long-duration capital. Pension funds and sovereign allocators prefer stable risk metrics. The $9 purge cleaned the book and made large entries more attractive. Retention hook. Later, we'll model January surge probabilities under two inventory scenarios. Minor behavior matters too, Producers often pause forward sales when markets are broken. If miners withheld hedges after today's chaos, supply at the margin tightens. That's bullish. Timing is critical. Days remain until the monthly and yearly close. The monthly candle is the signal long-term allocators watch. A monthly close above the breakout level tells capital allocators a secular shift may be underway and prompts January allocations. Watch these indicators: COMEX warehouse changes, mint backlogs, and ETF inventory reports. If COMEX outflows persist while spot chops, that's a structural bullish divergence. If inventories spike, expect longer consolidation. Empathy anchor: you can't control intraday noise, but you can watch supply. Inventory tells a truer story than any flashing candle. Actionable tactics: scale purchases into confirmed physical outflows, avoid new leverage before the close, and set alerts on vault reports rather than every tick. The market will paint fear. The inventory numbers will reveal whether it's fear or fundamentals. Contrast hook: headlines scream crash, inventories whisper shortage. Dive deeper. Open interest and warehouse numbers are not gossip. They are balance sheet facts. A notable drop in open interest after a purge means fewer contracts can cascade on a future shock. In practice, that lowers the probability of another rapid margin spiral. Similarly, ETF and mint backlog data reveal real demand. If ETF holdings tick down but COMEX warehouses also fall, that's evidence metal is leaving financial wrappers into industrial hands or private vaults. Ghost Week amplifies these signals. Thin liquidity makes moves larger. Thin liquidity also makes custodial flows more revealing. So during the holiday, small measured outflows carry outsized informational weight. Put simply, watch flow, not tape. Next, we map how algorithms reacted to the shooting star and why their withdrawal may clear a runway for institutional buyers. Algorithms do not feel, they measure. When the chart prints a $9 range in one day, risk models light up. Think like the machine. Algos digest realized volatility, not narrative. A shooting star candle spikes intraday variance. Value at risk expands. Programs reduce position size, throttle buying, and widen spreads. In plain terms, the machines step back. Microhook. This matters because when algos withdraw, price stops being propped by short-term liquidity. And that creates a chop that looks like death to momentum traders, but like a discount to patient allocators. Algos care about minutes. Pension funds care about months. Pension allocators evaluate monthly returns and long-term supply. For them, a $5, $10 intraday haircut is a bonus. The rug pull that liquefied leverage is a clearance sale for billion-dollar allocations. Contrast hook. Algorithms see risk, allocators see opportunity. When algos retreat, two things follow. Realized volatility falls as participation contracts. The market becomes quieter in public prints, but fuller in earnest bids placed off exchange. Large buyers enter stealthily to avoid slippage. Empathy anchor. If you trade like an algo, high frequency, high leverage, the new regime is painful. If you allocate like a pension, patient and size aware, it's a rare opening. Now add miners. Producers watch this and paused forward sales. They hate selling into manipulated chaos. Withholding hedges removes incremental supply just as the paper market looks weakest. Less forward supply tightens the physical pipeline. Retention hook. Next, we'll model how miner behavior plus institutional stacking can compress available metal and accelerate a squeeze. Bank desks reacted too. Some spent ammo defending levels today, which preserves a temporary ceiling but increases future upside risk. They burned position to save a day. That makes the next rally more explosive because fewer natural sellers remain. Technical implication: open interest dropped. Fewer contracts mean fewer margin-triggered cascades. Paradoxically, the purge reduced systemic fragility until new leverage rebuilds. Microhook. Up next, how this cleaning process creates a runway for strategic money in January. Practically, over 48-72 hours, expect algo caution, chopped tape, wider spreads, and stealth accumulation by large accounts. Option theta will punish impatient traders. Institutional flows will be discreet and slow, not headline grabbing. Empathy anchor. If the screen makes you queasy, step back. The machines are reorganizing liquidity. They are not rewriting the long-term story. Picture a $1 billion allocator. They won't chase a spiky minute. They wait for cleaner open interest and evidence that leverage is gone. Then they buy via bilateral contracts, dark liquidity, and scheduled vault deliveries, execution that shows up as inventory outflows, not a single visible buy. That process takes days, not minutes. Delivery channels matter. Institutions use insured vault networks and avoid retail rails that suffer fulfillment risk. So expect measured buy orders and persistent outflows in vault reports rather than a single headline bid. Meanwhile, miners pause hedges. When producers withhold forward sales, marginal supply tightens. Combine that with industrial procurement, converting paper into metal, and available inventory can compress quickly. That compression, matched with stealth institutional demand, seeds a reflexive loop. Rising price draws allocators, allocators thin supply, price rises further. Final thought. The very mechanics that caused the crash can amplify the rally. The purge cleaned sellers. That asymmetry can make the next upside move more violent once patient capital commits. This is where the story stops being a commodity rally and becomes a structural repricing. Silver is both an industrial metal and a monetary hedge. In a world of stretched balance sheets and regional tensions, that dual role changes buyer psychology. When banks wobble and supply chains strain, buyers allocate capital, or not trade it. Contrast hook. Paper players scalp headlines, strategic stacks buy insurance. Unit bias is the quiet engine. At low prices, silver was impulse. At $80, it becomes meaningful. An ounce now fits institutional mandates. That reclassification invites patient capital. Microhook. In a moment, we shall show how unit economics open the door to new buyers, and why that shifts price mechanics. Reflexivity accelerates moves. Price creates demand. Demand validates price. Validation draws more allocators. The loop compounds slowly, then rapidly. Geopolitics adds fuel. Sovereigns and central banks use metals as non-sovereign collateral. When currencies face stress, metal allocations rise. Industrial demand, solar, EVs, medical, is structural and growing. When production cannot scale instantly, shortages become persistent. Empathy anchor. The market tests patience. That test is painful but necessary for price discovery. Contrast hook. The same thin order books that allow a flash crash also enable violent squeezes. Market depth matters. At $20, institutions distorted the market. At $80, they can join without catastrophic slippage. Higher nominal values broaden the buyer base. Mandates change. That increases demand elasticity. Microhook. Next, we map buyer types. Sovereigns, pensions, miners, corporates, and their likely impact on the path to triple digits. Supply inertia is real. Mines take years to expand. Recycling is slow. When supply lags demand, shortages are structural. Ideal for squeezes. Reinforcing loop, rising premiums accelerate hoarding. Small bars, rounds, custodial stacks, shrinking the float. Reduced free-floating supply plus stealth institutional accumulation increases short squeezability. Retention hook. Watch COMEX warehouse counts and mint backlogs together. Simultaneous declines are a red flag for transitory narratives and a green flag for structural reallocation. Psychology. Panic sells the next trade. Conviction builds wealth. The purge removed speculative tourists. Remaining holders are intentional. Intentional holders do not sell to intraday noise. That hardens the market. Consider the buyer map more closely. Pension funds adjust allocations on monthly math. Sovereigns add reserves discreetly. Miners may withhold forward sales. Industrial procurement ladders purchases across weeks. Each buyer class executes differently. Pensions via dark liquidity, sovereigns through bilateral deals, industry via scheduled delivery, and together they soak up supply without creating headline spikes. This structural change converts a headline-driven tape into an allocation market. The more allocations shift, the harder it is for shorts to resist a squeeze. Time horizon. This is a multi-month regime. The route to $100 will be choppy. Expect algos and headlines to create volatility. Still, physical flows, larger allocators, and industrial demand point higher. Contrast hook. Today's purge was brutal for speculators. It cleared a runway for long-term money. Final pivot. A squeeze needs concentrated shorts, limited float, and rising buyer pressure. Several of those conditions are now in place. The speculative cap was thinned, physical scarcity whispered louder, institutional readiness waited backstage. There are 48 hours left. This is not the moment for hero trades. It's the moment for discipline. First, audit your leverage. Be honest. If today's $9 swing made your stomach drop, you are too exposed. Margin magnifies noise into force. Reduce it. Close positions that require constant babysitting. Move risk from instruments that can be liquidated against you into positions that cannot be touched by an algorithm. Volatility is a tax. Stop paying it. Pacing reset. Survival comes before profit. Second, mark the line that matters. 75. That level is no longer arbitrary. It was resistance. It became support. It absorbed a cascade. As long as price holds above it on a closing basis, the breakout thesis stands. If we revisit it during thin liquidity, that is not panic territory. That is a test. Tests are where markets reveal truth. Microhook. What happens at 75 over the next 2 sessions determines how January opens. Third, ignore intraday theatrics. Ghost week liquidity will remain thin. Spreads will widen. Candles will look ugly. This is not information. It is noise. Do not sit in front of the screen all day. Set alerts. Walk away. The chop is designed to bore you into mistakes. Contrast hook. The market wants your attention so it can take your position. Fourth, think in allocations, not trades. If you intend to add, scale. Divide entries. Physical first, then fully paid positions. Avoid options unless you are selling volatility with defined risk. Time decay is merciless in sideways markets. The next impulse will reward patience, not speed. Empathy. Anchor, frustration is part of the process. The market uses boredom where it used fear yesterday. Fifth, watch the data that matters, vault flows, dealer premiums, open interest. If inventories continue to drift lower while price chops, accumulation is happening quietly. That's the tell. Headlines will miss it. Tape will disguise it. Flow will reveal it. Microhook. Tomorrow's inventory print may tell you more than 100 candles. Sixth, prepare mentally for the pin. Banks prefer year-end prices that look contained. Expect attempts to cap rallies. Understand that pinning is not defeat. It is pressure. Pressure stores energy. Energy releases later. Seventh, secure custody. If you hold physical, verify storage, insurance, and access. End of year is not the time to discover friction. If you hold paper, confirm counterparty exposure. Stability beats cleverness here. Pacing, reset. Boring is bullish. Finally, zoom out. The month is closing. The year is closing. A close above the breakout zone prints a signal that monthly allocators respect. That signal does not vanish because of a wick. It compounds. You do not need to predict tomorrow. You need to be positioned for next month. Reduce fragility, increase staying power. Let the market do the work it is designed to do after leverage has been flushed. The chop will test you. That's the point. Endure it. This is the verdict. The shooting star was a test, not a tombstone. It looked violent because it was designed to be. A market that wants to move higher must first prove it can survive stress. Today's stress-flushed leverage revealed real bids and showed where physical demand refuses to bend. That's not failure. That's calibration. Empathy anchor. If you're shaken, that's normal. The purge was meant to shake you. Context decides candles. A shooting star at the end of a decade-long run can mark exhaustion. A shooting star at the start of a breakout, printed in a holiday liquidity vacuum, often marks a liquidity test. We tested 83. Sellers appeared. We tested 74. Buyers appeared faster and stronger. The range is defined. The market learned. Micro hook. The monthly close matters more than the wick. Here's why. Monthly and yearly closes are the inputs long-term allocators actually use. A close above the breakout zone prints a message that daily noise cannot erase. It tells models that the regime changed. It tells committees that risk-reward improved. It invites January allocations that dwarf retail flow. If we close the month above 75, it will be one of the strongest monthly finishes in history. That single fact outweighs any intraday drama. Algorithms will recalibrate. Pensions will rebalance. The calendar flips. Contrast hook. Daily traders read fear. Allocators read math. Now the path forward. Expect chop first. Resistance near the wick will take time to chew through. That's healthy. Each sideways day rebuilds energy. Open interest is lighter. Sellers are fewer. Buyers are patient. When the push comes, it won't announce itself. The wick is not a ceiling. It's a target. Markets love to revisit extremes to test supply. The sellers who wanted out sold during the smash. When price returns, supply will be thinner. That's how squeezes begin quietly. Microhook. This is how 83 turns from fear into fuel. What about 100? Timelines are probabilities, not promises. With cleaned leverage, firm physical demand, and institutional readiness, the physics point higher. Whether it happens in Q1 or Q2 matters less than the setup. The setup is intact. Final checklist, distilled. Stay unlevered enough to hold through noise. Defend 75 on a closing basis. Watch physical flows, not headlines. Let time work for you. And remember why you're here. Protection and participation, not adrenaline. Pacing reset, breathe. If 2025 was the year silver woke up, the coming year is when it goes to work, as a strategic material, as a monetary hedge, as an asset class large enough for serious money. The purge was the entrance exam. You passed by staying solvent. The bull wasn't killed today. It was tested, and it's still standing. The quiet after the storm is where positions are built. Stay patient. Stay prepared. Because when the real money steps in, it won't look dramatic at first. Then it will look inevitable.